Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is October 16th, 2025, and we're diving into the third quarter earnings report of Martin Midstream Partners. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Martin Midstream Partners has released their Q3 2025 financial results, and there's a lot to unpack, from their net loss to the withdrawal of their full-year guidance.
Revenue and profitability overview. Let's start with the financial highlights. Martin Midstream reported a net loss of $8.4 million for the quarter. Can you elaborate on this, John?
Certainly. The net loss is primarily due to weaker-than-expected performance in their marine and grease businesses. Despite this, they managed to achieve an adjusted EBITDA of $19.3 million, which is a key measure of their operational performance.
And what about their revenue and dividend?
They reported revenues of $168.7 million, slightly down from last year. They've also declared a quarterly cash dividend of 0.05 cents per unit, which reflects their commitment to returning value to shareholders, albeit modestly.
Segment performance analysis. John, can you break down the performance across their business segments?
Of course. The transportation segment saw a significant drop in adjusted EBITDA to $5.3 million, mainly due to reduced demand for inland barge fuel transportation. On the other hand, the terminaling and storage segment performed well, with an EBITDA of $9.7 million, thanks to stable long-term contracts.
What about the sulfur services and specialty products segments?
The sulfur services segment faced some headwinds, but managed an EBITDA of $3.9 million. The specialty products segment also reported an EBITDA of $3.9 million, though sales volumes in the grease business were below expectations.
Operational challenges and strategic outlook. Martin Midstream has withdrawn their full-year 2025 guidance. What does this indicate?
This decision reflects the uncertainty in their transportation segment, particularly with inland barge fuel transportation. The leverage ratio increased to 4.63x, but they remain in compliance with debt covenants. The focus is now on strengthening the balance sheet through disciplined capital allocation.
How do they plan to navigate these challenges?
They're concentrating on operational efficiencies and cost management. The CEO emphasized the importance of maintaining compliance with debt covenants and improving their financial position.